Good morning, everyone. It's just after 10 o'clock, so I think we can get started here. My name is Tyson Moore. I'm a supervisor in the not-for-profit division here at DWD. I want to take this time to thank everyone for joining today's webinar covering nonprofit financial statements. With us today is Susan Berghoff, along with our presenter, Carrie Minnick. Before we get started, I have just a couple of housekeeping items to cover. For those of you who have questions during today's webinar, please use the Zoom's question and answer feature. You should see that option on the toolbar at the bottom of your screen. Both Susan and myself will be answering questions periodically throughout the presentation. Also, Carrie's slides will be emailed to everyone attending the webinar today, along with being posted to our website. So without further ado, I'll turn the floor over to our Director of Nonprofit Services, Carrie Minnick.
Thanks, Tyson. Thank you all for attending today. Before we get started, I just want to remind everybody that the term nonprofit does not mean that an organization cannot or should not make a profit. So a lot of times when we talk about nonprofit financials, that sometimes comes to mind, and we just need to remember that that is not the case, that a nonprofit does need to bring in more money than it spends in order to survive and continue to grow to support its programming. So when we're talking about financial statements, we first kind of need to think about who all is looking at our financial statements. And, obviously we have management, the board of directors, they're looking at it to manage the organization, making sure that the decisions are being made properly. But then you also have some outside individuals that are looking at your financial statements, donors and funders. Oftentimes they will require you to submit audited financial statements. Reporting agencies, if you get any kind of government money, sometimes they may require you to submit financial statements. Bankers, sometimes if you have loans, they may require you to submit some type of financial statement. And then of course your auditors at the end of the year, or reviewers if you have an audit or review done. And then also the IRS. And while the IRS does not directly ask for a copy of your financial statements, the information that is on your financial statements is reported on your annual 990 that goes to the IRS. So there's a lot of different people that are viewing your financial statements, and that's really why it's important to make sure that the items are recorded properly. And then also, I know a lot of nonprofits will put their financial statements on their website. That is not a requirement. You are not required to make your financial statements public. However, a lot of organizations do, and that's fine. So again, anyone in the public can obtain your financial statements and look at it if you are putting it on your website. Just a few things to talk about in general about financial statements before we start looking at an actual set of financials. There are really three types of accounting methods that can be used when you're looking at your financial statements. So organization A may follow one method while organization B may follow a different method. So when you try and compare these two financial statements, they're going to be a little different. It's going to be more like comparing apples to oranges. So the easiest to understand and to use is the cash basis. So this basis is when revenue and expenses are recognized when the money is actually received or spent. So this is basically just like your personal checking account. When you get paid, you record revenue. When you write a check, that's when you record the expense. So pretty easy. On the other end of the spectrum is the accrual basis. This is a little different because revenues and expenses are recognized when they're incurred. So for example, oftentimes funders may send a letter to a nonprofit saying, congratulations, we're going to give you a grant. We're going to give you the payment for this grant though at some time in the stated future. So under the accrual basis, the nonprofit would need to record that revenue when they receive the grant letter notifying them that they are going to get that award versus when they actually get the check. Same thing when an organization provides services and gets paid for those services. So let's say that an organization has like a day camp on Saturday and they charge a fee for the kids to come. So even though the families may not pay the fee on that Saturday, they may be billed and paid later. The organization is going to recognize the revenue on that Saturday when that service was provided. And then on the other side for expenses, expenses are going to be recognized when incurred. So when you make the purchase of goods or services versus when you actually pay for the invoice. So the accrual basis has a lot more accounts. It's a lot more complicated than the cash basis. There's also a modified cash basis, which is a mixture of the two. It basically starts with the cash basis and then kind of pulls in some different accrual basis type transactions. A lot of the modifications include, recording fixed assets as an asset, capitalizing those and depreciating them, recording the fair value of investments, and then payroll liabilities. So it's very important to understand which basis of accounting your organization uses. The basis is determined at the beginning of the organization's life. You can choose to change if needed, but that's really not something that happens a whole lot of time, and definitely shouldn't be flip-flopping back and forth between methods of accounting. But it's really important for your board and management to understand what basis of accounting you are following. So that way, when you're looking at your financial statements, you have an understanding of what is recorded and what is not recorded. So again, I said the cash basis is really the easiest to follow. And so if you are an organization that doesn't need to provide your financial statements to a bank or a funding source, you might find that the cash basis is the method for you. Also, if your operations are very simple, your accounting functions are unsophisticated, don't have a lot of loans or capital expenditures, that's probably a good situation where you may use the cash basis. Again, it's very much easier to understand the cash basis. The modified cash basis may be good for instances where, again, you don't have a lot of outside reporting for your financial statements, because again, if you do receive some grants or government funding, they may require you to file your financial statements with them on the accrual basis. So that might not be an option for you to use the modified cash basis or the cash basis. But if you don't have any outside reporting that has those requirements, you don't have a really complex set of books, but maybe you do have some debt, or maybe you do have a decent amount of capital expenditures, you own a building, you have fixed assets, you might want to consider using the modified cash basis of accounting, because in that way you can report those assets on your books. So here we can see a comparison of the three methods. And like I said, under the cash basis, that is the easiest because we basically have cash and receipts and disbursements. That's it. And then we move one step up to the modified cash basis. So again, we still have cash, revenues, and expenses, but then we're adding some more assets. Maybe we're adding investments, fixed assets, debt, that kind of thing. And then as you can see under the accrual basis, we have a lot more going on. And again, that's why this is the most complex set of accounting methods to follow. And here you can see kind of just a comparison of the three methods. Again, under the cash basis here, this first column, when we're looking at total assets, we only have $50,000 of assets to show. But if we, under the same transactions, if we use the modified cash basis, our total assets will increase to 157. And then if we follow the accrual basis, again, same transactions occurred, it's just what basis we're using it on. You can see that there's a difference. So again, total assets increases to 162.5 under the accrual basis. And then if we go down to the bottom here, where we're seeing our contributions, our revenue and expenses. So our increase in net assets, which is basically our net income, under the cash basis, it's only 20,000. We move to the modified cash basis, it's 26.3. And then under the accrual basis, it's 23.3. So again, just wanted to show you that there is a difference, giving all things the same as far as what transactions actually occurred. What basis you use will have a significant impact on what is actually reported in your statements. So there's also a difference between internal and external financial reporting. Your internal financials, those are what's going to be printed from your QuickBooks or your MIP, your internal accounting software. They may be presented on the cash basis, where your external reporting Your external reporting is going to be maybe your audited financial statements at the end of the year, or your reviewed financial statements could possibly be on the accrual basis. Oftentimes, the internal financial statements aren't going to look the same as those audited or reviewed financial statements. Obviously, they're not going to have all of the footnotes in the back, but they might not have the functional cost allocations between the three functions, which we'll talk about a little bit later. They probably don't show board designations. Obviously, they could if you have a sophisticated internal accounting reporting system, but a lot of times there are some differences. So what you're looking at internally throughout the year may look a little different than what you see at the end of the year if you have an outside accountant come in and do an audit or a review. For those of you that come from the for-profit world, there's also differences between nonprofit and profit financial statements. So in the for-profit world, we have retained earnings. We don't use that terminology in the nonprofit world. We call them net assets. Also in the for-profit world, we have net income or net loss, and we use the terminology increase or decrease in net assets. The nonprofit world also has some other terminology that for-profits do not use. We have contributions, promises to give, donor restrictions, board designations, and functional expenses, which we will go into here in a moment. When looking at the actual set of financial statements, we also have some different terminology that we use to call those statements. Your balance sheet in the for-profit world, we call it a statement of financial position. For-profit entities have an income statement, where nonprofits have a statement of activities. For-profits also have a statement of stockholders' equity. Nonprofits don't have that because we have no owners. No one owns a nonprofit organization. However, we do have a statement of functional expenses, which we will go over, that for-profit entities do not have. And then we both have the statement of cash flows. So just kind of wanted to go over some differences there when looking between nonprofit and for-profit, internal and external financials. So now we'll get into looking at the actual statements themselves. So the first one is the statement of financial position, or the balance sheet if you're a for-profit. This is as a specific date in time. And then there are some requirements of different amounts that need to be required on this statement. But most important, when you're looking at this statement, assets have to equal liabilities plus net assets. So let's look here at our first statement. So this is a statement of financial position. As you can see, it is as of a specific date. So it is as of December 31st. We do show 2 years, and the statements that we're looking at here are going to be an external set of financial statements, so like an audited set of financial statements. So it may look different than your internal financials. However, the information on the internal financial statements is going to be the same. For the most part, it's just going to be in a different format. Next here, I said that assets equal liabilities plus net assets. So when you're looking at your statements, your total asset balance has to agree to your total liability and net assets. If these two numbers do not agree, then your statements are incorrect. At the top, we have our assets, and our current assets are those that are that can be converted to cash within a reasonable short time, usually within 1 year. And usually the assets are listed in order of liquidity. So cash is usually at the top, because it's pretty much in order of how easily these assets can be converted into cash. And then in the same fashion, we have current liabilities. So these are the liabilities, the amounts that are due to other people, and how fast they're going to be paid. And as we talk about the different financial statements, you can see how they all interrelate with each other. So for example, the cash and cash equivalents that is on this statement is going to flow through to the statement of cash flows. And then also we have our net assets down here at the bottom that flow from the statement of activities. So that's kind of the overview. So now let's take a look, dig into the different items that are actually on the statement of financial position. So obviously we have cash. I think everybody knows what cash is. Cash equivalents may be your certificates of deposit that are short-term, less than 3 months, or money market accounts. Contributions receivable are amounts that someone has told you that they are going to give to you in the future. So again, maybe that foundation said, hey, congratulations, we're going to give you a grant of $50,000, but we're not going to give it to you until next month. So that would be recorded as a receivable on this line. Prepaid expenses are those expenses that are paid in advance. So for example, oftentimes insurance. So usually the insurance period extends beyond, like for example, this year, December 31st that we're looking at. And so that amount that is paid for coverage in January and February is going to put in as a prepaid. Or for example, you might prepay for a location for your special event. So let's say we're going to have a special event in February of 2022, and we paid, $1,000 down payment in December to use that location. And so that would be considered a prepaid on this statement. Cash restricted to long-term purposes is money that's been set aside or restricted by a donor to either be put into your endowment or to maybe purchase a fixed asset, maybe build a building, because that money needs to be set aside for that specific purpose as opposed to be using in operations. We need to split it out on a different line on the statements. Investments are your, obviously investments in securities, equities, those type of things. Property and equipment is going to be your buildings, your vehicles, your equipment, those items that are capitalized and depreciated over their useful life as opposed to expensed. So normally a nonprofit will have a capitalization policy in place where they say that items with a life in excess of 1 year over a certain dollar amount, oftentimes it's $500 or $1,000, we will capitalize that asset and put it on our books as an asset and then depreciate it, basically expensing its cost over its useful life. And then finally, beneficial interest. This is a common one. This is basically your investment in, for example, the community foundation. There are 2 funds at the community foundation. This is the one that is recorded as an asset on your books. So those are your assets, the items that the organization owns or that people are going to be paying them if it's receivable. The next section is the liabilities. And this is what the organization owes to other people, outside organizations, entities, businesses. First line is the line of credit. So if we have a line of credit with a bank, we're going to owe that back to them. Accounts payable, that is going to be the amounts owed to someone else. And again, these statements are on the accrual basis. So if you follow the cash basis or the modified cash basis, you will not have some of these line items, but this would be the full accrual basis where everything gets recorded. Back to accounts payable, these are the amounts that you owe to vendors for goods or services that you've received and you just haven't paid for yet. Accrued payroll and withholdings. This is going to be the amount that you have withheld from your employees' payroll checks and you have not remitted the taxes yet. Also, this is going to be the amount for payroll for individuals who have worked and haven't had that paycheck paid to them yet. So for example, oftentimes at the end of the year, your last paycheck, it does not go through December 31st. It'll probably go through maybe, let's say, January 7th. So an employee may work from, let's just say, like December 20th through January 7th, but they don't get paid till January 7th. So as of December 31st, that employee has earned and the organization is liable for the work that they did from December 20th to December 31st, and that needs to be recorded as a liability on the books. Deferred revenue is revenue that is received by the organization for future services. So if you get paid in advance for some type of service that you're going to be paid in the future, this is basically kind of like a holding account until that service is provided. And then when that service is provided, it moves from this liability account into revenue. A refundable advance, hopefully we won't have to deal with these too much longer. This is basically, in this instance, would be the PPP loan. There could be other instances where you receive a government grant in advance, and it's conditional, or it's something must happen. For example, the PPP loan, the forgiveness from the SBA had to occur before it could be recorded as revenue. So again, it's kind of like a set aside account that it's sitting in until we receive that forgiveness. Capital leases are leases of items that the organization is leasing the equipment, and then at the end, they're actually going to buy it. This actually is going to be changing here actually during this year. So we'll see a lot more capital leases on the books. So those are your total liabilities. Again, liabilities are what you owe other people. The last section are your net assets. So this is basically your cumulative net income, if you want to think about it that way, since the beginning of the organization has existed. Net assets are divided between without donor restrictions and with donor restrictions. So with donor restrictions is money that donors have given to the organization for either a specific purpose or a specific time period. And as of the end of the year, it hasn't been spent yet. So if I give you $10,000 and I say it has to be used for program X, at the end of the year, you have not spent that yet. So we need to put that in as with donor restrictions. So it's basically set aside to be used for a specific purpose in the future for program X. Without donor restrictions is everything else. It's if I give you $10,000 here, congratulations, I love what you're doing, you can use it for whatever you want, then that would go on without donor restrictions line. Only donors can restrict money. Board designated is a different story that we'll talk about. That is when a board says, hey, we are going to set aside unrestricted money for a specific purpose. That is different than when the donor restricts it. So this money here is just, we're talking about funds that donors have given that have been restricted for a specific purpose. So when we are looking at our financial statements, our monthly financial statements, whether you work for a nonprofit, whether you're a board member, whether you're the executive director, when you get your monthly financial statements and you are looking at your statement of financial position, what do we need to look at? What do we need to ask? First of all, we really need to compare this year to last year. What are the significant variances between this year and last year? And should there be variances? So, when COVID happened, we should see a lot of variances between 2020 and 2019 or 2019. But going forward, was there other significant changes in operations? Did you add a new program? Did you lose a program? Did you hire new people? All of those things are going to affect your financials. And so when you're looking at your financials, you need to think about what happened during the month that is going to affect these numbers. And should I be seeing a variance? And if I'm not, why not? Or if I am seeing a variance and I wasn't expecting that, why? We need to ask that question. Also, when you're looking at your statement of financial position, we need to look at our cash balance. First of all, we hope that it's positive. We don't necessarily want to see negative or liability for our cash. So we want to make sure that we do have a positive cash balance. But how much cash do we have on hand? There's no rule that says that a nonprofit can only have a certain dollar amount of cash. However, you as a nonprofit organization are not in the business to hold cash, to make investments. You are in the business to do your programming. Therefore, best practices say that 3 to 6 months of having cash on hand to cover 3 to 6 months of expenses is really what we need to shoot for. If we have more than that, why? Are we saving up cash to start a new program? Are we saving up cash to build a new building? If we're getting, a hefty amount of cash, maybe we need to think about what we should use that excess cash for. So again, there's no specific rule or law that says you can only have a certain dollar amount of cash. However, you really need to think about what that cash is being used for within the programming in the organization. Also in relation to cash, restricted cash. So this statement here shows $100,000 that is restricted for long-term purposes. So if you were to have restricted cash on your books like this, you need to understand what that is for and make sure that, yes, you are going to be spending it on that. You want to look at your receivable balance. Is your receivable balance growing from last year? Should it be growing? In this instance, contributions receivable is 320,000 compared to 4,000 last year. So this organization likely got a large grant. It could be a multi-year grant this year, and so they had to record it on their books. So likely this was expected. However, if it wasn't expected, and that receivable balance keeps growing, it could be that we have individuals, funders that are not paying us what they owe us. So we need to make sure and watch out for those growing receivable balances. Is it because people aren't paying us what they owe us, or is it because in this instance where we got a large grant this year? Investments, if you do have investments, it's really good to know what's going on in the market. If the market is up, then our investment should be up. If the market is down, then our investment should be down. So we want to make sure that we're understanding also what is going on in the surrounding environment and how that affects our balances. As far as fixed assets, this organization has a significant amount of fixed assets. So we want to be aware of how old our fixed assets are, because we are going to need to replace those at some point. And when it comes time to replace those fixed assets, are we going to have enough money on hand to do that? Or are we going to have to, get a loan? Are we going to have to apply for a grant? We really want to understand how old our equipment and fixed assets are, so we understand and have a plan on replacing those. As far as under the liability section, again, accounts payable, we want to look at last year. Are we lower? Are we higher? And why? If the accounts payable balance continues to grow, is it because we are not paying our vendors on time? That could be a significant issue. Same way with the accrued payroll and withholdings. If that continues to grow, are we not paying in our payroll taxes? Are we not paying employees? Which hopefully is not the case, but that could raise a significant flag if those balances continue to grow. And then finally, under the net asset section, we want to make sure that our balance without donor restrictions is positive. If that balance is negative, that's not good. That means that we have borrowed money that has been restricted by donors for a specific purpose to use in operations. And we really don't want to be doing that. That is not what we should be doing. So we want to make sure, first of all, that our net assets without donor restrictions is positive. And we would really like it to be a good amount because really that's what can be used for our everyday regular operations, as opposed to the with donor restrictions that has to be used for a specific purpose. So that's kind of an overview of the statement of financial position. And as we looked through those, there were a couple instances where I referred to like a capitalization policy. So here are some related policies to that statement that if you don't already have in place, you might want to consider. And if there are any policies that we talk about today that you do not have and would like to have a template for, you can please just feel free to contact us and we can provide that to you. Cash reserves, is there a policy in place that says how much cash that we should have in hand, and what are we going to do if we exceed that, what it's used for, that type of thing. Investments and endowments, if we do have investments, what can we invest in, what are the purposes, who has access to that, when do we withdraw those investments. Capitalization policy, again, what are we going to capitalize versus expense? What's the dollar amount? Is it 500? Is it 1,000? Along with that, asset replacement plan. How are we going to replace our assets? It'd be a really good idea to have some kind of plan in place, a schedule that shows all of our current assets and determine when we are going to have to replace those. And then determine, okay, what available resources are we going to have at that time to purchase new equipment? Because pretty sure that you're going to need to have that equipment in order to do your programming. So if something were to happen, and the equipment died, you weren't able to access it, you might not be able to do your programming anymore. And then finally, board designated. So again, board designated is different than a donor restricted. If the board decides that they want to set aside a portion of unrestricted funds that have come in for a specific purpose, they can certainly do that. This policy kind of puts in a plan in place as to how that happens. It should be approved by the board and then documented in the minutes. And then also, what are we designating it for? What are the procedures for using it, that type of thing. So just a few policies that you might want to consider putting into place if you don't already have them in place. So next we have the statement of activities or the income statement. So unlike the statement of financial position, which is as of one date in time, really a snapshot of the organization at one date, this is for a specific period of time. So it could be for a month, it could be for a year, it could be, year to date, maybe January 1st through March 31st. It just depends. And this report is really going to show your revenues and expenses, where you're getting your resources from, and what you're doing with those resources. So again, here is an example of a statement of activities. And as you can see at the top, this is for a specific period of time. So again, the other statement, the statement of financial position, was for one date as of December 31st. This is for the year ended December 31st. So that means all of the activity from January 1st through December 31st is included on this page. And we actually have 2 years here. So this is 1 year, the without donor restrictions, with donor restrictions, and total. And then we have the second year. So we have 2 years, the current year and prior year, so we can compare. You will notice that there is a line called net assets released from restrictions. This is different. This is not in for-profit statements. This is very unique to nonprofits. Basically, this is just a reclass from the column that says with donor restrictions to without donor restrictions. So again, let's talk about the donor restrictions. When someone gives money to a nonprofit and they say it needs to be spent on a specific item or program or for a specific period of time, that is called with donor restrictions. So that's going to go in the with donor restrictions column. Then when we spend that money, it's going to get moved from the with donor restrictions into the left column without donor restrictions. Basically, it's just 2 pockets. So you have 2 pockets in your pants. One is with donor restrictions and one is without donor restrictions. So when you get the money in, you put it in the right pocket for with donor restrictions. So it's set aside separate from the money you can use in your left hand pocket for all of your operations. Then when you need to spend it, you can move it over to your left-hand pocket and then spend it. So there is no effect on the bottom line for this transfer here. It's just moving it from one pocket to the other pocket. And again, and then we have our change in net assets, which again is basically our net income. So we have our total support revenues and gains, less our total expenses, comes down to our change in net assets or our net income. And then at the bottom, these are our net assets. And so again, these amounts tie into our statement of financial position that we just looked at. And then our expenses here are going to flow from our statement of functional expenses that we'll look at next. So again, it just shows how all of the statements tie together. All right, so when we're looking at this statement, again, there's 2 years here. So we're just going to focus on one, the 2021 here. So at the top, we have our revenues, our support, where we're getting our resources from. Contributions and grants. So this is going to be our donations from foundations, from individuals, from corporations. They are giving us money and expecting nothing in return. So that's what a contribution and grant is. We might have some in-kind contributions. So let's say someone donates, some legal or some advertising to us. And if they didn't donate that advertising to us, we would have had to pay for it. So that gets recorded on our books as a contribution. So that gets recorded both as a revenue item and an expense. So there's no effect to the bottom line, but it does get reported on our books. Membership fees. So this organization has some membership fees and program fees. So again, if your organization provides some kind of service that you receive payment for, so that's what's on these two lines. It's an exchange transaction. The organization is providing some type of service, and in return, they are being paid. And so that's separate from our contributions. Rent income, if you rent out part of your building, then you would receive rent income from that. Other income is really just a catch-all of just, non-recurring or very small amounts that really don't fit into any other category. And then also we have investment income. So if you have investments, that's going to be your interest, dividends, gains on investments. We have to record those as well. Or if you sold fixed assets and you had a gain or a loss, that would be recorded here as well. So that's your revenue section. And then the next section are your expenses. So nonprofits are required to report expenses by 3 functions: program, number 2, management in general, and number 3, fundraising. And so that's what on this statement, that's all that it's reported by, are those 3 functions. Now, there are 3 programs listed here because they have 3 significant programs for their organization. Some organizations may only have 1 program listed here, and that's completely fine. If you only have 1 program, or if you have multiple programs that are very similar in nature. If, however, you have large programs that are significantly different, you probably should list those separately to give the reader a better understanding of your different programs. So program expenses are those expenses that directly and indirectly relate to providing your program services. So because you offer this program, you have those expenses. Management in general relate to the overall operations of the organization and really aren't identifiable with a specific program or fundraising. So no matter what programs you offer, you are running an organization and you're going to have these expenses. So like your accounting fees, your payroll processing fees, your bank fees, those are probably going to be all management in general, because it really doesn't matter what type of program you're offering. Those are just general business expenses. And then your fundraising expenses are going to be those costs that are related to trying to get people to give to your organization. So if you send out a year-end mailer and ask people to donate, if you have a special event, some of those expenses are going to be included in here. So those types of things. All right, so when we're looking at the statement of activities, what kind of questions should we be asking, or what should we be looking for? Okay, first of all, we need to really understand what time period we're looking here at the top. This is for the whole entire year. When you look at your financial statements throughout the year, you're probably going to either see it by month or year to date. So that's really going to have a significant impact on what you're looking at. So, because year to date maybe is going to be different than looking at just the monthly income and expense. So you want to have an understanding of what the period is that you're looking at. Just like on the statement of financial position, on this statement, you want to compare to last year. So where are the significant variances? Should there be variances? And are there variances that aren't expected? So for example, if we have a significant decrease in contributions, why is that? Did we lose a funder? Because that really wouldn't be too good. Or did our contributions go up, and why? Did we gain a funder? We need to, when we're looking at our revenue, we need to make sure that we don't have any significant concentrations, which means we're not relying on a significant grantor or funder to fund all of our operations. Because if that revenue source were to go away, would our organization be able to survive? So some organizations receive a significant amount of government funding, which is fine. But if that government funding leaves and your organization is relying solely on that grant, would your organization be able to survive? Do you have a backup plan? Or even a local foundation, or even an individual? If you're getting a significant amount of revenue from a single source, you really need to evaluate that and determine if maybe, hey, maybe we should go out and get some different funding sources. Another thing to look at as far as revenue is, where are we getting our revenue from, as far as, is it related to our purpose, our mission, or are we getting kind of like one-off weird types of revenue? And I say this because nonprofits are exempt from paying income taxes. However, nonprofits are required to pay unrelated business income taxes. So unrelated business income is income that is received by the organization that is not related to your purpose, your mission, what you're doing. It does not matter what you do with that money. So the IRS doesn't care that you're putting that money back into your organization. They care about the source, where it came from. So if you do have some unrelated business income, revenue that is not related to your purpose, there's some other requirements for it, but you may have to pay income tax on, or UBIT, unrelated business income tax on it. So just if you get a new revenue source or something is a little different that you haven't done before, you just might want to understand where that revenue is coming from, and if it does create any kind of UBIT issues. As far as expenses, again, comparing to last year, did this go up? Did this go down? Why? And then also, how much are we spending in relation to program management in general and fundraising? Are all of our monies going to fundraising? Are all of our monies going to management in general? That type of thing. Where are we spending our money at? Also, when we look at the change in net assets, the total change in net assets for 2021 on here is an increase of $688,000, which is great. That means more income than expense. But we really want to look at this first column here where it says without donor restrictions. That is negative. So that means that without donor restrictions, our regular operations, that's negative. Oftentimes that's because the timing. So when we go back to with donor restrictions, we have money that has come in this column here with donor restrictions, but we might not spend that money until the following year. So there's going to be a timing difference. When you get money in, it may not all be spent in the same year. So you really need to understand, if you get money that's restricted, what it's for, what period it's for, and when it's going to be spent, because that's going to affect these financial statements. When you're looking at the statement of activities, there's a few different policies that you might want to consider putting into place if you don't currently have them in place. That's a gift acceptance policy. So what type of gifts will you accept? This really helps in situations where a donor may come to you and ask if you want to receive this gift, and it's a non-cash item that you really have never considered that you want to accept. What kind of issues are going to be created if you accept this gift? For example, if a donor comes and says, hey, we want to give you this building. Well, if you've never owned a building before, if you don't have enough funds to support the maintenance of the building, if you don't have enough people to support the upkeep of a building, then you might not want to accept a building. So having a written policy in place that is already in place, so when people do come to you and ask you these types of things, is just a great idea to have that. Contribution substantiation. So in order for an individual to take a tax deduction for a contribution on their individual tax return, they have to have certain documentation from the organization proving that they gave them that contribution. So having a process in place within the organization to shows how we are going to thank our donors, how we are going to get that information to them, is going to make it much easier than waiting to the end of the year. And then finally, the expense allocation policy. I briefly mentioned that nonprofits have to report expenses by program, management in general, and fundraising. So in order to do that, we kind of have to have a policy in place as to how we are going to allocate those expenses. Are we going to allocate it based on number of people? Are we going to base it on square footage? What basis are we going to use to allocate those expenses? And speaking of expenses, our next statement is the statement of functional expenses. So again, this is for a specific period of time, just like the statement of activities. This technically could be in the footnotes. Most people do put it in as a statement just because it's easier to read, looks a little better, it just flows better. So our statement of functional expenses, again, is for a specific period. So it is for the year ended December 31st, 2021. So again, these are all expenses from January 1st through December 31st, 2021. And when we look at this, so this is only for 1 year. So these total balances at the very bottom, those are going to flow into the statement that we just looked at. So this is just really providing more information. So we have our 3 programs. We have management in general and fundraising. So the functions are across the top: program, management in general, and fundraising. And then the natural classifications are down the left. So what is the expense actually for? Is it for salaries? Is it for taxes? Is it occupancy? That type of thing. The amount of detail that you go in down the left really is up to you. You want to have enough detail so the reader understands your expenses. However, you don't want to go too crazy and list all of your expenses that you have in your trial balance. So there's no requirement that says you have to have a certain number, or you can't, or you have to have a minimum or maximum number of accounts down the left. But it's good to obviously separate your payroll and salaries from your other expenses, because usually those are the largest expenses for the organization, and those are a little different than your other expenses. But that's one thing to look at when you're looking at your statement of functional expenses, is asking, is this providing the detail and information as it should be? Or do we need to go through and maybe change up what we're looking at here in order to make better decisions? So another thing to look at when you are reviewing your statement of functional expenses is, how much are we spending? How much of the total 1.7 million, 1.8 million here at the bottom is being spent on programs versus management in general and fundraising? So on this report, 89% is spent on program, 8% on management in general, and 3% on fundraising. So again, we want most of our expenses spent on programming. I think the Better Business Bureau says at least 65% should be spent on program. Charity Watch is at 60%. United Way likes to see no more than 25% spent on supporting services. So really obviously you don't want to manipulate the numbers to get those percentages. You want to have a reasonable allocation method in place to allocate those expenses, but you want to make sure that you are really spending your money on most of it on programming. Organizations that are just starting up or that are much younger, haven't been around as long, they are going to have higher management in general and fundraising percentages than organizations that have been around for a long time, likely, because they are still in the startup mode. So they're still raising money, they're still setting stuff up. Maybe they haven't really started their programming yet. So they are probably going to have more management in general and fundraising expenses. The percentages are also going to vary from organization to organization. So that's one thing to always keep in mind too. If you are comparing your organization to other nonprofits, it's very difficult because yes, you are all classified as nonprofit organizations. However, you all do completely different things and you get money from different sources. Some nonprofit organizations get all contributions. Some organizations rely heavily on program service fees. You have different programs, you've been around different amounts of time, you operate differently, you're in different locations. So I just want to caution you that when you try and compare your organization's financials to other organizations, that might not always be the best way to do it. It's probably better to compare yourself year over year, see where you were last year compared to this year. Let's see. So again, looking at the financial statements here on the statement of functional expenses, when you're looking at it, again, the biggest thing is what percentage is being allocated to programs versus management and general and fundraising. And then again, comparing it to last year, what has changed? Where are we spending our money? For nonprofits, salaries and employee benefits, payroll taxes is always going to be the largest because it's your people. So that's probably always going to be your largest expense. Again, and this is just the same thing. So we have last year to look at so we can compare this year to last year. The final statement is the statement of cash flows. This is probably the most difficult statement to actually understand. Again, it is for a specific period of time. And so we can see here at the beginning or at the top that it is for the year ended. So this is all of your activity from January 1 to December 31st. So it's over a whole entire year. And we have two columns. We have the current year 2021, and then the second column is last year, so that when we're looking at it, we can compare. Basically, what we are doing is seeing where our cash is coming from and what it is being used for during the year. So the first section is our operating activities. Operating activities depicts cash inflows and outflows from our primary business operations, what we're doing. In this instance, it is negative, which means we used more in operations than we got in, which that happens. Ideally, we like to see the cash flow from operating activities as a positive number. The next section is the cash flows from investing activities. And so this is our cash that we use to purchase fixed assets or investments, which we need to do occasionally. So for instance, this organization purchased $137,000 of investments. They also purchased $54,000 of property and equipment. So they invested some funds, which is fine. So again, this statement really depicts where we're using our cash. Is it for operations? Is it for investing? And then finally, is it for financing? And financing is where are our loans. So if we have to take out loans, if we're repaying those, that's the cash that's being used in that section. So when we're looking at the statement of cash flows, again, we want to see cash flows from operating activities. Really like that to be positive, but again, it does go negative occasionally, and that's fine, that happens, but we like to see that being positive. At the very bottom of the page is our total cash at the end of the year. So we want that to hopefully be positive. We don't want to use more cash than we have available. And then also, is our cash balance growing? And we kind of talked about that earlier on the statement of financial position. So where is our cash? If we are continuing to grow our cash, or do we have a plan for it? Are we going to invest in future equipment, furniture, buildings, or are we going to start a new program? What is our plan for that excess cash? And again, you can see here how the statement of cash flows, again, flows back to the statement of financial position. So those are all of the statements of a nonprofit organization. So really overall, when you're looking at your statements, any of the statements, we really want to look for changes from prior year to last year. What changed? Were we expecting the changes? Do we have negative balances where there should be positive balance? Do we have negative cash? Do we have negative net assets? That's not good. How are our revenues compared to last year? Did they go up? Did they go down? If they are continuing to decrease, that might be cause for concern. Or if we have a significant amount of increase in expenses, how are we using our resources? Do we have a high amount of management and general expenses? Why? Do we have negative cash flows from operations? Why? Did we purchase a significant amount of fixed assets or have a huge amount of debt this year? If we did, that's going to totally affect all of these statements. And that's another reason why, as a reader of the financial statements, you really need to know what went on during the year to make sure that those activities, transactions are reported properly in the financial statements, but also understand how they're going to impact your financials. Here I just included a few ratios. I know some people like to do calculations on, financials. So here's just a few common ratios that you could calculate for your nonprofit. That kind of talks about, how they're doing. Again, just make sure that if you do decide to calculate some of these, again, these are not all of them. These are just some common ones. When you're calculating them, start with comparing your organization to last year as opposed to going out and just comparing it to any other nonprofit. Because again, nonprofits are so different. It is very difficult to compare one organization to another organization. And again, just want to remind you that your financial statements, they're really telling your organization's story. So in a number format. So everything that happened during the year is being put into numbers on your statements. And again, there's a lot of different people that are reviewing your financial statements. So you really want to make sure that your financial statements are being, not only that the numbers are being reported correctly, but are the expenses on the statement of functional expenses the expenses that you want to show? Are the revenue sources on your statement of activities properly disclosed? Should we split out contributions and grants, or can we combine them together? So just looking at your financial statements, what is the story that they're telling? And is it the story that you want it to be saying?
All right, great job, Carrie. I just want to remind everybody on a few things. So we have, this session was recorded. So the slides and the video will be available on our DWD website in the not-for-profit section. We're also going to email out a link to everybody who's attending today. While you're on that page, you can also register for our next webinar that'll take place on May 12th. It's going to talk about debunking nonprofit myths. I just went to our website. I think all of these webinars are now available for you to register. So take a look at that when you get a chance. I want to thank everyone for joining us this morning and have a great rest of your day.